Welcome to this concluding episode of our special series of business talk conversations we've been having with Wendy Myers, who's a seasoned professional in the world of securities, head of securities at PSG Wealth, one of the country's top brokers, talking about how one approaches investing from understanding the different asset classes to building your nest egg and obviously your legacy and your financial freedom. And today it's only fitting that we conclude with what is often referred to as the only free lunch in investing, diversification. Wendy, great to chat to you again.
Thank you, Michael. Yeah, it's good to be here again.
Now, we've unpacked how to structure a portfolio, taking into account one's risk appetite. So perhaps this is a good time to fully unpack what diversification actually means and why it's so important for investors to ensure that this is achieved when structuring a portfolio. But before we unpack diversification in the context of portfolio construction, maybe let's just remind the viewers what diversification actually means and why it's important when it comes to portfolio construction.
Yeah, I think, Michael, what I'd like to leave the listeners with is really around diversification needs to be seen as a very powerful tool that assists investors achieving the right balance between growth and risk that is relevant to their situation. Every investor's got their own unique requirements, and diversification allows you to put that personal spin on your portfolio to help achieve your ultimate goals. I think the key for me, diversification in the context of investing, is really around the spreading of your investments, and that would be among and within those different asset classes available to us. I think in simple terms, Michael, it means don't put your eggs into one basket, and look to achieve diversification through the allocation of your investments amongst the various types of building blocks, is what I like to call them, which is stocks, bonds, and cash.
That really comes down to, and I like the analogy of not putting your eggs all in one basket, because you can quite clearly see why it's better to spread things around in case there's an event or you drop one basket, you still got two or three, and so your entire portfolio doesn't blow up. It comes down to correlation, doesn't it? The correlation between assets also affects the effectiveness of diversification. And, it's an interesting time that we're having this conversation because generally equities and bonds are fairly uncorrelated. So when one asset class is doing quite well, the other maybe is not, and vice versa. Now in markets, we're having another repeat of what we saw 12 months ago with bonds and equities selling off in lockstep. But in the main, this idea of correlation is important. Can you just explain how correlation is used to diversify a portfolio?
So I think really it's around making sure that you've got the right mix. So, and I think, there's so many options available to investors. So I think that's why it's important to look at saying, well, what diversification opportunities are available to me? So you can look at diversifying across the asset classes. So we've spoken about shares, bonds, and cash. And that's because, as we've said, in a similar market and in similar economic circumstances, they behave very differently. I think, it's important to understand that broad asset classes such as shares have sub-asset classes, and that really talks to your large caps, your mid caps, and your small caps, which have very different investment returns. There's also different definitions of the type of share. Think of a growth stock. We've touched on that before, Michael. Think of a value stock. And remember, growth is all around capital gain, really. They typically don't deliver dividend income. And value stocks deliver really a blend of both of those returns. And then you get a share that delivers both growth and value within the same share. There's also the opportunity to invest both domestically in the local market. There's international stocks available to us. So diversification really gives you the ability to stretch your portfolio to give you multifaceted returns. And I think the key takeout for me is really around deciding what is that right asset allocation that gives you the comfort as the investor that your portfolio will deliver the returns for you over the long term.
Yeah. And even within that, I was going to say within equities, you then can go into sectors and there's sector diversification. So you start at the top and then you build it down in layers almost. And
Mm.
when you consider, we've discussed this in the past, risks and time horizon, I think this is where it really becomes quite important to sit down with a financial advisor. But how should we be thinking about structuring our portfolios through this lens of diversification when considering risks and time horizon? And what are some of the common risks associated with investing?
Well, I think sector risk is a very real risk for investing. Um, really, that's where you are overweight or underweight, even a particular sector. I think, a good example is the banking industry with interest rates being high. You might want to have slightly higher exposure to the banking industry, but then you need to accept that risk and know that if there is a specific risk that impacts the banking sector, maybe an increase in recoverable debts, which impacts the return of banks, then your portfolio will be negatively impacted. But we also know that in a high risk environment, the banking sector is positioned to make good money. And so in theory, their returns will be stronger. But sector risk is a very real risk to the portfolio, as is volatility risk. And I think that is the one that tends to drive quite bad behavior by investors if the volatility risk of their portfolio isn't aligned to their own personal appetite. We know about market risk, but we want to make sure that as the portfolio goes up and down because of the market returns, the investor is comfortable to accept that level of volatility. I think currency risk is a risk that a lot of investors shy away from, but I think it's actually a very positive contribution to your portfolio returns. You want to make sure that your portfolio delivers a real return from a dollar's perspective. You don't want to just have rand returns. Even when rand returns look quite good, you might find from a dollar return perspective, actually the portfolio is underperformed. And then I think finally, the last risk I want to talk to is liquidity risk. And that really is the risk around your portfolio not meeting your short-term liquidity requirements. We've spoken at length around the benefits of dividend income and how it provides the cash for investors to live off if that's their need, or reinvest in the market. So liquidity and the ability to have a choice around that money is a very necessary part of investing and part of your portfolio return.
So you don't become a forced seller, for example, in an emergency situation, and you've got to liquidate a position at the wrong time, at the bottom of the cycle. And that's the last thing you want to be doing, crystallizing those losses. There's also the other risk of not diversifying at all. I mean, what is your biggest risk should you not structure a well-balanced or diversified portfolio?
Yeah, I think that can actually very easily happen, Michael, as part of your journey, because I think you think, well, I'm starting out, I'm defining my portfolio construction, I'm comfortable where it is at the moment, and then you don't check in, you don't make those annual reviews of your portfolio to say to yourself, has it met the requirements? Am I still comfortable? Do I still want 5% allocation to the technology sector? Maybe I want 2%, or I want further exposure to local banks, not offshore banking sector. So I really think the importance around having a portfolio you need to look at rebalancing your portfolio, and that's where a financial advisor can certainly assist you, because it's quite difficult to make some decisions, because often it's an emotional reaction that you're trying to steer away from. So really, I think the importance of rebalancing means that an investor needs to look at what is their current portfolio construction? Do I need to tweak it? And by doing that tweaking, it really means by selling some securities that have a bit of profit on the table, maybe even some that are making losses, and then buying those stocks that are going to position your portfolio to do well for the long term. And just making sure that you're comfortable with that sector allocation and that international versus local allocation. And then really, I do want to encourage investors when they do that to make sure that they sit down with a financial advisor, because it's the financial advisor that's experienced to keep you on track it's very easy when you do that rebalancing, when you sell, to think, oh, it's quite nice to take that money and maybe put it elsewhere. But the important is to make sure you put it back into the market and keep your portfolio positioned for the long term.
I worry with rebalancing, and that there's a fine line here between rebalancing one's portfolio versus responding to market volatility sometimes. So how do we get that right? Because obviously rebalancing means making regular adjustments to ensure that you're hitting your target allocation over time and managing your investment risk. But what is your process to rebalance to ensure that you're not just responding emotionally to some market volatility and you're making the right choices in rebalancing?
No, I think for me, when I look at mine, I look at how frequently I want to do that rebalancing. Some financial advisors recommend quarterly. I think it's probably a bit frequent, but it's not a bad thing just to have a glance over your portfolio. I like the idea of doing it annually. I sit back and I look at, how it's performed. I look at what my cash flow requirements are. I also look at transaction costs. I think investors must be aware purchase and sale, certainly of equities and bonds, drives transaction costs that impact the performance of your portfolio. I look at what works well for me from my risk appetite. I look at tax considerations. I might want to add some tax-free saving accounts with exposure to ETFs into my portfolio. I might want to say that actually I don't have enough exposure to certain balanced ETFs that just by being invested in that ETF provides adequate rebalancing for me. So it's really around sitting down and saying, well, what works well for me in the context of the limitations of rebalancing, and making sure you do the optimal rebalancing, taking consideration the costs and tax consequences.
Yeah, there's so much to consider, and all the while spreading that risk and maintaining focus on some high conviction investments as well. But again, it all boils down to understanding your departure point, but then sitting down with a professional to help guide you along this financial journey, and having those regular checkups, almost like you will as you kind of sometimes get into your 40s, and you really should have the annual checkup with the doctor. I mean, that's
Exactly.
really what we need to be doing with our financial wealth. Wendy Myers, thank you so much. It's been a wonderful series taking viewers of Business Talk through the first principles of investing, basically. I'm sure they've found it very valuable. I've certainly found your insights hugely invaluable with us over the last few weeks. So here's to many more successful portfolios built into the future. Take care.
Thank you very much. Thank you, Michael.